Good afternoon, everybody. Well, welcome again. This is Michael Poole with PCE, and welcome to our first webinar series on navigating your business through uncertain times. This one is how to survive your bank debt. I'm being joined today with Eric Zaleski in our Chicago office. I'm down in the Winter Park office. So we have a little bit of a tag team presentation, and hopefully it'll feel nice and smooth for you all. So one of the things that is becoming a lexicon new in the world of companies today is whether your business is considered essential. Talk to any business owner and they'll tell you, yes, my company is essential. But this is in the terminology of a pandemic. The federal government has suggestions for what's essential. And the easy ones are healthcare, but some of the other ones that you'll find in certain states are hardware stores or alcohol or liquor stores. So what you do find is that each governor has the ability to set up what is essential. And we're finding that that is a very broad-based definition. In fact, one of our clients who has a manufacturing of metal products here in Florida is considered essential. But his competitor that's located in Pennsylvania is not considered essential and is being shut down by the governor. So one of the key things you should be asking yourself or your clients is, are you essential? We believe that bankers will be looking at your company as they look at your loans and restructuring your debt if necessary as to how you fit into that definition within the state that you operate in or states you operate in. So cash is king. That's always been the truth, but it's even more true when you talk about it in the concept of crisis. And so this seminar is about making sure you're focused on preserving as much cash as you can, liquidity, and in doing that, it allows you to work better with your banker, and your banker wants you to have that same type of liquidity. So this is the focus of today, is making sure that your cash is king in the way you're operating your company today and how you're dealing with your bank. So, and why banks? Well, that's where the money is. I had to find some levity, and, you know, although I don't want you guys to be bank robbers, it is where the money is, and that's why you need to work with your bank. When you're working with them, this is a key, and we're going to talk about that, and which is we think, three areas that we're going to talk about today, which is relationship, reporting and analysis, which is going to be even more important today's environment, and implementation. So as I said, joining me is Eric Zaleski, and Eric, being many things, one of his great strengths is he worked in the banking industry. And yeah, Eric, why don't you talk and tell us a little more about what's important in dealing with a banking relationship?
Sure. Thanks, Michael. It's a pleasure to be with you all today. And I want to say, as an aside, I think we all may be working under the stay-at-home order, and Michael and I are no different. So please bear with us if you hear some noise, or more specifically to me, some homeschooling going on. Relationships are key in a lot of business aspects. Employees, clients, vendors, and of course, banks. Banks are your partner and should be viewed that way. Communicating with your banker is of the utmost importance in times like these. Do not hesitate to be on offense and contact them first. Make it a habit to do it consistently and establish a schedule. Even if it's okay to check in, say hello, ask how the bank is doing, show interest in them and build that connection. Don't be afraid to show transparency. Be open, be forthright, as this may curtail questions they have. Not all will be answered by you or the bank at the original time, but that's okay. These important steps will allow you to be straightforward in your needs and requests. Banks will require time to address these needs, and the more touches and updates you provide will make the bank's process more efficient and helpful to you. After putting together your communication plan, assessing your business should be considered. You should meet with your management team on a consistent basis and take all aspects of your business into account. It will help the leaders internally to guarantee everyone is doing the right things for the business. Utilize your employees and be open to suggestions. Do not be afraid of change to operations or process. If you prefer an outside look, there are operational assessment guides available that will provide you questions, which then will allow you to obtain that independent view and assist in these uncertain times. Lean on your professionals, investment bankers, advisors, accountants, lawyers, etc. Addressing and attacking an honest assessment of your business will continue to create a solid partnership with your banker. A relationship-oriented banker will appreciate your efforts and in turn be an advocate for you within the bank. Remember, your banker has the duty of being on the front line as an officer. They work with you, understand your needs, and guide you to success. However, they also have the obligation to report back to the bank. Taking these proactive actions will get you closer to obtaining your needs and solidifying your partner, the bank. Financial analysis is prudent in all business environments, but more so today. Providing financial statements, projections, and cash flow reports will assure that you are diligent in looking at operations and progressing towards success, which will be valued by your bank. If you have not historically had to provide monthly financial statements, it is important today and going forward when we exit this environment to provide those to your banker. If they currently do not request them, it's still a good idea to have on hand and review with your team each month. This continues communication, builds trust, and allows action. Projections and cash flow are vital to your business. The projections allow you to track what you anticipate today and then compare to actual performance. I can't stress enough that this comparison should be done at least monthly. This scrutiny will allow you to pivot quickly and proactively. Cash flow statements will track how you are changing operations. We'll discuss operations and cash flow more in the ensuing sections. Accounts receivable and payable should be reviewed weekly. Any slippage in the AR will constrain cash. This has a significant impact on your operations. Similar to AR, AP should be examined for changes. Be cognizant of what you can and cannot do. Combining these financial reports and creating a package or PowerPoint will allow the bank to easily track on a monthly basis. Include a narrative in the beginning outlining the changes month to month. Your analysis, which shows projected versus actual, reflects trends and is very important report to focus on. The bank will be doing the same. Once the reporting package is created, it will be easy to update and also be a great tool for internal management discussions on the state of your business. As Michael said, I was a former banker, went through these times in 2008, 2009, and when clients provided us with these reports, it was extremely useful, not only to them, but to the bank. Made our job a lot easier to address their needs at that time. So Michael, moving on, what specific areas in these reports should be analyzed?
So I like to look at customers, and customers are what you need to have a company. Without them, there is no business. So in this area, we all should be calling our customers and asking how they're doing in this time, whether they're having any troubles with their customers, how are their employees, and are they having any trouble with suppliers, such as yourself? Because their customers are the beginning of your cash flow. Again, that's the end source of your cash is king. So you need to be really working hard to understand what they're doing. And that goes into looking at that account receivable aging that you have, and that you might not have paid as much attention to that in the past. But today, that's an almost weekly, maybe even daily occurrence, because your customers might be asking you to give them some more extended terms to help their business stay afloat. Then obviously the other side of that is the suppliers, the vendors, which is your accounts payable side. So this outflow of money needs to be looked at as well. in talking to your suppliers, because you need to find out whether or not certain materials that are key to your business or services that are key to your business can continue to be available. Right before all of this happened here at our company, our IT specialist company lost a major client and closed down their shop within a week. So I can't imagine going through what that issue is today that we had to go through with maybe about 60 days ago. So you can understand that if somebody you depend upon has lost a major customer of theirs, that how it might impact your business. So that's why you want to touch base with your suppliers and make sure that you understand what their risks are. Then the other two areas that we like to look at is workforce. We have one client who believes that his business is going to drop by 50% in the next 30 days. And he, up until this time, he was having record revenue and record profits. His game plan is to keep all of his employees available and paid for because he's concerned if he lays any of them off or put them on furlough, that his difficulty in getting them back is going to be very, very hard. So his plan is to keep them all employed, and he's in the manufacturing business. So he says, we always have delayed maintenance and delayed cleanup and always planning to make the lines more efficient, but we never had time. And so he's going to use this time to clean up his manufacturing processes. And the other key area is expense control. And this is the hardest one for owners because we're always want to not cut anybody back. And we're always not wanting to cut somebody off that we buy product from or use services from. We always wait. We have a tendency to wait to make cuts too late in the cycle. So in this time when things are coming so abrupt, I really encourage you to go through those expenses and ask yourself, do I really need this expense? And does it really keep my doors open tomorrow morning? And if it doesn't, then you really need to put that in that category of let's cut it today, or I need to somehow reduce it and only pay and look to incur those expenses that relate to keeping your doors open the next day. Eric, after you've done this analysis, how does that fit into the cash flow statements that you talked about creating?
Sure. So going back to the beginning slide at the front part of our presentation, cash is king, especially when financial times are tough. Cash flow is different than projecting financial statements. It looks at cash in and looks at cash out. It allows you to look at cash or checks to be sent. So ask a question of yourself. Are my suppliers vital to my clients who are buying from me? Depending on that answer, it may determine how you approach your payables. How does your cash position measure up to the financing available from your bank? Continue to review your line of credit balance, if you have one, versus the collateral that supports it. If you don't prepare a report such as a borrowing base certificate, which tracks this information, it will be a useful exercise to you internally to see availability. It's very important to keep dry powder on hand, so establish a cushion. To Michael's points earlier, analysis of customers, vendors, workforce, and expenses are key when managing cash flow and making decisions. Get these under control and maximize cash. Don't be hesitant to do what's needed to keep the business in a solid cash position, which may mean making some tough choices. Develop the habit of preparing your cash flow on a regular basis. Once you have a base case, you should create various scenarios. Look at an upside scenario, something like 10% above your base case. Then address a downside or worst case scenario, maybe to the tune of 20% off your base case. From there, take a conservative approach and manage the business from base to downside. In the instance of negative cash flow, when do your cash reserves run out? Again, look at having that cash reserve on the balance sheet. Can you borrow on the line of credit or potentially other assets? A suggestion is to have enough availability in cash or on the line of credit to cover up to 1 month's expenses after you've made your adjustments. Also determine if you're better off or even able to cease operations for a period of time to preserve cash. This will allow you to restart when conditions change. If you have positive cash flow, be content with your position. It's a great starting point, but don't waste it. Conserve it. Continue to review what events could change this to a negative position and stay on top of it. Your cash flow statements will map out how your company will navigate the several weeks to months of that pandemic. Again, review on that consistent basis and look at changes that need to be made. Financial statements need to be timely for internal and external review. If you are more than 45 days behind, then you cannot see results quickly enough to make good decisions, which makes you more apt to be in trouble. In addition to the items Michael mentioned in expense, client, and supplier analysis review, CapEx should be taken into consideration. Defer all growth CapEx until entirely out of the woods. Prioritize all maintenance CapEx. There is likely a longer time that some maintenance can wait. For example, it may present a good appearance to refinish fixed assets every year, but in reality, it could withstand 2 or more. Additionally, you may find deals to be had on fixed assets, but take a look at the cost layout in the short term versus the return on investment. Determine assets that are not leveraged for availability to access more capital if needed. For instance, unencumbered real estate, other fixed assets, or cash surrender value of life insurance. Run your covenant analysis now for at least through the end of the year. Banks will work with you, and it is important to provide that outlook now, especially Q1 to Q3 2020, as it still includes the positive 2019 performance you may have had. Specifically look at excess cash flow recapture if you have one. Almost all are based on 2019 or trailing 12-month results. Since the pandemic was not anticipated, the excess cash to cover additional principal payments is unlikely available. Again, your bank will work with you on waiving it during this time. After analyzing your covenants along with your cash flows and projections, ask to defer principal payments today. Deferment is a very likely option and would merely extend the amortization around 3 to 6 months worth of those payments. It's been indicated that the regulators are encouraging banks to be proactive on the covenant relief. That means take action to modifications now. Do not wait. From what we've heard in the market, regulators have indicated they will not downgrade credits and require the banks to increase their capital reserves. This is drastically different than 2008, and the Fed is looking to be supportive and not restrictive. If you do not have a personal guarantee now, plan on the banker asking for one and be prepared to say yes. How you deal with a personal guarantee depends on what you need. Parameters should be put in place as there needs to be consideration on both sides. Will they require a cash injection versus a personal guarantee? Will the personal guarantee be limited or have a reduction period? Will they require reduction in personal compensation to offset that personal guarantee? If you have seller debt payments, be prepared to have those suspended. Michael, what other options and programs are available today whereby companies can receive a capital infusion and avoid some of these bank restrictions?
Thanks, Eric. Thanks for giving the lead into our next webinar that you and I are going to do together, which is about other sources of capital. But one that's really on the tip and easier for folks to get today is the CARES Act. So in the CARES Act, that $2 trillion plus or minus bill that the Congress just passed is a section for businesses. There's 2 buckets of money. One's called the Paycheck program, and the other is this distressed companies. The $350 billion one is the one we're going to focus on today. The distressed company loans has not been defined as well yet on how that is going to be managed. But here are some highlights of the Paycheck Protection Program. There's some things that you have to certify. That is but the economic conditions is not causing this for you to come make this loan request, and that the money will be used to retain workers and can be used on mortgage and lease payments and utility payments. What's really nice about this is that it requires no collateral or a personal guarantee, just that subject that Eric was talking around that always kind of makes someone shake and sweat a little bit when they have to do a personal guarantee. So in this case, no personal guarantee. The interest rate is 0.5%. Earlier reports were that it's 4%, but we've been told and seen comments that it's now down to 0.5%, and that it could be repaid up to 10 years. But I'm really seeing this as more like 2 years that this could be done. And you don't have to, under like most SBA loans, you have to kind of prove that you could get the money someplace else. In this case, you don't have to do that. The max loan amount is the lesser of 2.5 times your average month payroll costs for the past 12 months, or $10 million. Again, we've just heard in the last 24 hours that it's no longer the last 12 months, but it could just be calculated off of the 2019. Your banker that you will be dealing with will help guide you on what that number is. One thing on employee costs, on the payroll costs, is that no employee can, in doing this calculation, can be higher than $100,000. So you'd be limited in those payroll costs. And payroll costs is not only the compensation, but the health care benefits, any state or local taxes that you might pay for that person. It excludes the employer federal taxes that they pay, that's 6.5%, so that's not part of it. And includes vacation and bonuses and commissions and anything else in there, including any contributions to IRAs. What's nice about this too is not only the interest rate and the immediacy of this, is the loan forgiveness section. So 8 weeks after you borrow the money and you start spending it, that if you spend it for the payroll costs and the rent and the interest or utilities, you can get this amount forgiven by the bank. You're going to have to provide them some proof that you made these payments, but any amount that you've paid out in that 8 weeks will be forgiven. What's interesting is that the law, how it reads, is any payments made or incurred. So it's difficult to determine whether or not that if you pay your payroll, let's say arrear in every 2 weeks, that not only could you get some payments that you made for payroll that really incurred payroll costs before you borrowed the money, and then and maybe you made a rent payment right before your 8 week period was up, but it was really for the forward. So it hasn't really been determined whether it's just kind of on an accrual accounting basis or whether it's part accrual and part cash. My sense is that some of those rules are still trying to be determined, and it could be a lot determined by your bank. Now, this is immediate. The doors open for this for applications tomorrow, and banks are working hard to figure out all of the mechanics. In fact, I was with one bank president this morning, and he said that the SBA staff was just being trained on it today. So we're going to see a lot of mistakes, I think, or could be a lot of delays in trying to get answers. But they've been saying that from day one on applications that companies might start seeing a check within the next week to 2 weeks. That'll be fantastic for a lot of companies and fantastic for their employees. This clearly is like a 2-month retention program to keep companies open and employees paid to lessen the impact of the pandemic. Eric, did I hit all the highlights for that?
Yeah, I think that was well said. I know it's inflow and influx from day to day, but I would suggest everybody out there contact their banker immediately about this because they are getting bombarded by a lot of people on the front end. So you want to get your share.
All right. So returning back to the implementation, so we've talked about communication and relationship and reports you ought to be putting together. And now you're going to go and meet with your banker and tell your story. And remember that that is a lien on the future. And so all of your story has got to be is about how bright the future for your company is, even given this terrible time and crisis that the economy is in and individuals are in and businesses are in. We got to say, hey, my company is strong enough to endure this. This is how I can do it. And this is the way I can drive myself out of this given this time. So you have to paint a realistic picture, but you want to be optimistic and positive. So make sure that your story is about how you can repay their loan if you do certain things, and keep on that storyline. And if you update your banker weekly, if it's that nervous for you both, then that's the thing you need to do. Again, communication with your banker is key to a strong relationship. The other note we want to leave. Yep.
We have we have a question out there.
Okay.
What about using a non-depository lender versus a bank for the CARES loan?
What I've read up on it is that the SBA is first starting out with lenders with their approved lenders, and then they're slowly moving to allow others in the lending business to do that. I think, though, from a timeliness standpoint, that unless they're approved and can take applications and you can verify it, I would go to your bank. Because that's where you need to go to, is the approved SBA lending banks is where you need to start. And what I've heard from talking to numerous banks is that if you don't have a banking relationship with them, they'll deal with you, but you're at the back of the line. They're going to deal with their customers first because that's who they have loans to. Eric, do you want to add anything to that?
No, that's exactly what I would have said. You talk to the SBA approved lender and make sure you go to your bank first.
All right. One of the things that in crises, and you can go out and find a lot of great quotes. This is the one we wanted to use, and never let a good crisis go to waste. And what we want to leave you with here is that everybody who's operating a company and managing it has always wanted to do some maybe major changes in it or try some new things and to change the company in new directions. And sometimes in a crisis, we're looking down so much that we don't necessarily look out enough into the future and take advantage of this opportunity to make maybe major organizational changes or maybe go after new initiatives. And this gives you the impetus to go after that new initiative because your old initiatives are on the sidelines. So if you got people that are there, what are they working on? Maybe going after the new initiatives makes the most sense. So again, in the words of Winston Churchill, never let a good crisis go to waste. So I want to, before we say goodbye, I want to make sure that if anybody has any additional questions, that we'd be happy to answer for you at this time. Well, Eric, it looks like we've done a great job in trying to cover the subject matter that no one has any more questions. I know they're not too shy on the list that the people have done. So I want to thank you all for joining us today. Eric, it was great to participate with you. I know you're cold up in Chicago.
Well, likewise, Michael, and hope everybody stays safe out there. And if you do have questions, feel free to email Michael or I, and our profiles are on our website. And again, stay safe.
Great. Thanks so much. Bye.